Yo, what's up guys? It's your boy Looney, and today we're diving into something everyone wants to know. And that is, how big should your account portfolio be? Or we're gonna look at your Robinhood portfolio based on your age and also how long you've been investing. And this is not about flexing or comparison, it's about using benchmarks to stay on track and grow your wealth realistically. And I chose today because of how the market is doing. Right now the market is down, and a lot of people often panic, and this is a good time to reflect on where you should be and where your mindset should be. And before we get into this video, quick shout out to the Discord. It is free to join, and then also I offer a premium membership, and that's $8 a month, and that gives you access to one-on-one coaching, trade callouts. I do giveaways, I have an option selling course, and more, but the links to that are in the description. But let's add some context, because most people start on Robinhood with just a few $100. Me and myself, I started with around 2,000 or somewhere around there, maybe even 1,000. And if you're 20 years old and just opened your account and you see someone with 50,000 in theirs, you shouldn't be stressed. And that's because you're possibly on a different timeline. So keeping this realistic, and let's say you're contributing around $200 a month and you're aiming to get that 7 to 10%, which is very conservative because that's what the market returns. And this is from a long-term investing, looking at index funds, solid stocks, etc. So the first year, where let's say you're around 18, maybe a little bit younger, or 25. Now, you could be a little bit younger and a little bit older, but you're aiming to have your account size 1 to 3,000. And again, you can diverge slightly, but this is a good benchmark. And this is when you're first learning the game, maybe doing some trades or figuring out what your style is. You shouldn't be focusing on size, but you should be focusing on habits realistically. And that means you shouldn't be buying 0 DTE options or 0 days till expiration options and day trade. You should really be planning strategies and just studying, focusing on what works, what doesn't work, what works for you, and what doesn't work for you. And for myself, year one, I sort of chose every strategy. And that was one of my biggest faults. I got invested into everything. So I did stocks, I did crypto, and I kind of just shot everywhere. And although I learned a lot from doing it, it actually diminished my returns because a lot of these stocks and industries and ETFs overlap with one another. So it's kind of killing my gains, and I'm still holding these, and I don't plan to sell them until I get a return that I feel appropriate or a better opportunity comes along and I want that capital ready. And I'm not actively investing into these companies anymore. I'm just using my dividends to reinvest. But year one, you should be focusing on learning, picking 1 to 5 different strategies, and really just studying them. And then we move over to year 2 or year 3. This is where you're going to want to have some momentum. And we could even put an age to it. That's where you're 22 or 28. Again, you could diverge slightly. And this is where you want to have your account a little bit bigger. So you want to have around that 5,000 to 15,000. And not only you're getting that from your returns or just straight from your profits, you're also going to want to be deploying some cash. So whether you want to do it daily, monthly, this is where you're going to be investing more consistently. And this is where you should have gotten a few winners or taken some L's. Either way, that snowball is building. Because if you're investing in dividends or stocks that compound, this is where you start to grow and you see that your money makes money. And year 2, I was sort of doing that. I was really focusing on stocks that I like. So I was doing Riot, Mara, and selling options. These are a lot riskier. I realized for myself, I like that risky play. I like doing risky stocks, but with safe strategy. So dollar cost averaging and selling options. You can see crypto, I was dollar cost averaging, and I'm just building position with those. And those are very safe strategies, but I'm doing them on risky assets. Now let's fast forward to year 4 or 5, because this is really where you're going to want to be in your growth phase. And this is where your age is 25 to 30 plus. And this is where your account, you do want to be at 15,000 or 50,000 or more. You want to be where I aim to be is 100,000, or at least that's my next goal. And this is where you've probably found your rhythm and you've really found out what strategy works, whether it's selling options, reinvesting dividends, or actually thinking long term. At this stage, time in the market really starts doing the heavy lifting. And that's what I've noticed for myself. I've been holding a lot of these positions, and just by simply holding them, they've grown. And I'm also selling options. So I'm consistently selling options on stocks that I like, that I want to own, like Oscar, Riot, Mara, and SoFi. And one of my biggest winners was SoFi. I sold options and was able to acquire 400 shares, and now I'm up 90%. I was up around that 100%, but we are seeing some volatility right now, and I'm up 89%. I'm also selling covered calls, and this strategy also works really good in any sort of market. Ideally, you want that neutral to slightly bullish market, but it does work in every condition. It just doesn't work as well. And selling options is a great strategy I've learned. I'm still doing the dollar cost average, and we can see that's paying off even with crypto, especially with the volatility of crypto and how much it moves up and down. I'm still up 60%. And I have taken profits back when I was up over 100%. Maybe I didn't take enough, but only time will tell. I'm not too concerned because now I have that long-term mindset. And again, doing dollar cost averaging and just compounding, just putting money in consistently, and really let time do its thing and work for you. Another strategy that I've been doing is buy calls. So buy long calls or leap calls. These are long-term dated options, and this is a really long-term strategy. You simply just buy a call with a long dated expiration, about a year out or a little bit more, and you just let it ride. Let it go through all the earnings, all the highs, the lows. Ideally, you want to do this when things are over or undervalued, and that's what I did on Riot. I noticed it was a little undervalued, so I bought a long-term call, and I'm up 65%. I was up a lot better, but again, I'm just holding long-term because I have that long-term mindset. Same with SoFi, and this one I didn't even time that well, and I'm still up almost 70%. So it's pretty crazy how a strategy as simple as this could work, because both of these didn't require a lot of capital. Riot only required $400. That average cost is $4. Times that by 100 is $400. So I had to have $400 to do that strategy. And then SoFi, I needed $760. So these two combined were around that $1,100 or $1,200 mark. And you can see just holding them long term has finally paid off. So just being patient is really what you learn as you move ahead. Now, I did give some benchmarks. Of course, there are going to be some things you can't control, and your actual Robinhood account size can depend on different variables. So one is how much you invest monthly. I was using examples like putting 200, but let's say you did 800. Obviously, you'd want your account to be a little bit higher or greater. And I don't even know what I'm investing at this point because I like to wait for better opportunities. I'm constantly investing, and I know I always say timing isn't as good as time in the market. And I do believe that. I'm constantly investing, but when there is sort of a bear market or just a lot of fear in the market, that's when I start investing a lot more heavily. So I don't really have a consistent deposit. But it really does come down to how much you're depositing. The other thing is if you're trading, doing swing trades, or you're just holding, that could actually affect how your returns act. Because if you're just holding, there are going to be some times where you're not going to be profitable. There's going to be some red days. And if you're just holding, that's fine. That's a perfect strategy, is to just simply hold and wait for whatever your asset is doing to finally become green. Whereas you trade, you can take advantage of the downturns and the upside of things, but it is a lot more riskier. And also another benchmark or another variable is side income. If you have a side hustle or bonuses or business, you also might have a different outcome with your portfolio size. The other thing is how early you started. And I sort of mentioned that before. I was giving some ages, but you could obviously start earlier than 18 and just start depositing as early as you can. And even if you're getting in later, where you're in your 30s first starting, it doesn't matter. As long as you're investing and building, you will realize that compounding effect. Lastly is market cycles. Again, time in the market is better than timing, but if you're investing during a bear market, your first year is not going to look good, but later down the line, you will see those returns. Whereas if you start in a bull market, you're going to see those returns immediate. I personally actually like starting in a bear market because you go through the emotions early on, and then you start to see that it finally pays off. So if you're just starting off and you have 2,000, or you're a little bit older and you have 10,000, you're still in the game. The real flex is showing up every month or every day and not showing off your biggest green day. My personal take is I did start slightly small, and there were months that I couldn't invest anything, and now I am doing a consistent strategy. So something like Robinhood is a stock that I'm consistently investing. I'm putting $2 a day, and this is a very beginner strategy. This is how you build a position. And if we do see a bear market, I'll probably do more than $2. But for now, doing a very small amount every day. Also selling cash secured puts is what I'm doing, and covered calls. And now I'm doing a little bit more risky trades like IPOs, which we looked at Figma. That one jumped around 200%. I was able to cash out. But the point is staying consistent. And over time, your portfolio reflects the habits and not just the deposits. So how big should your Robinhood account be? It should be as big as your discipline allows it to grow. Don't chase someone else's timeline. Instead, track your own growth. If you're up from where you started, you're already winning. And let me know, drop your Robinhood size and how long you've been invested in the comments. No ego, just tracking. And check out the free Discord if you want to grow with a community. Until next time, peace.